Mike Zuzolo is back to analyze the USDA report, the US trade with China, and the macroeconomic data from the United States. Connected Farmer is your channel to keep you up to date with the latest trends in agriculture and livestock. Mike, how are you today? Are you feeling all right?
We're still hanging in there, Luis. Everybody's doing well so far. We're thankful that the USDA report didn't create new lows in the market.
Yeah, so we start from there. Oh, what are your thoughts about the USDA report?
I didn't think it fed the bear in terms of promoting more downside price exploration, because usually my rule of thumb is pretty simple in commodities. Demand usually puts lows in the market, supply and weather issues put highs in the market. And as long as demand is increasing as prices go down, then you're finding that demand and the market is working correctly. When you look at the USDA report, even in the soybeans, where the USDA went from 425 million bushels ending stocks here in the United States, over 600 million bushels in this report, that barely changed the global ending stocks to still around 90.3 million tons. So in that example, and also the fact that they lowered the global wheat production by about 3 million tons because of what you and I have been talking about when it comes to Europe and their problems with production versus the Baltic states. I still think they're too high on Ukraine in corn and wheat, but you have these demand things that came in on the report that supported the market, I think. And I think the market was also waiting to see the USDA numbers after the terrible climate problem we had with the severe windstorms that came through the heart of the Corn Belt. Finally, in the supply demand side of the equation, I think the market is starting to realize that the drought issues are significant in our number one producing state of Iowa. And just today, we got our new numbers. Ohio is still at 70% drought. Iowa, our number one state, is still at 79%. And we have states like Minnesota that's almost 30%. And Nebraska is still at 55%, along with South Dakota and North Dakota, all of them in the mid-50s for drought. Last year at this time, these states were nowhere near that level of drought. So I think all of these things came together, along with a weaker dollar and some inflationary pressure, to really negate the big yields that USDA gave us on that report.
A lot of consultancies are speaking about, were speaking about the lower crop. So what do you think is going to happen in the next couple of weeks? Because prior to this report, many private analysts spoke about the lower yields, both for corn and soybeans in the Midwest.
Yeah, and I think this is where the August report becomes kind of a benchmark here in the United States, where the USDA will do a combination of MODIS satellite imagery along with farmer surveys. And then we start to talk about the size of the crop in terms of the number of ears per acre. And then we start talking about how big those ears are, the girth of and the test weights. I think this is where the August report usually puts out a pretty large number, and we tend to go down from there. I think last week when we spoke, I talked about this being maybe similar to 2016, in that farmers that I'm talking to and working with are seeing, in many cases, very large population, very green fields, but when they go into their fields, they see a lot of the ear has not filled out to the tip, which what we call tip back. And it's tip back that's bigger than what you would want given the variety or the genetics, because most ears nowadays have some tip back just because we plant such a high population. And so I think that as we go on, especially if we stay drier in the rest of August, we will start to take off the top end yield in corn and beans both. And as far as Iowa and some of these other states, the corn dough and dent is getting significant enough that it's going to be very difficult to add to the production and the yield side. So to me, the corn's getting more one-sided, Luis, where it's easier to take yield off than it is to add yield, and that 182 number that USDA gave us was already too high, and it's going to be extremely hard to make it any higher than that. So that's how I am projecting my yields. I'm going to stay below 180 on national corn yield, and I'll probably stay below 50 bushels, maybe 51 when it comes to soybeans. And that's where, if we have those kind of yield numbers and the kind of demand that USDA is talking about, the market, I think, has gotten put plenty of discount in the prices. So it opens the door to the upside, I think, at this point. The big hurdle now, because it's demand related, is the U.S.-China trade negotiations, because the USDA has put in a lot of corn feed and a lot of bean exports and a lot of corn exports into the numbers. And so now we are more reliant upon good U.S.-China trade negotiations and a good relationship, because those are in the USDA numbers now.
You are more bullish than ever.
I wouldn't say that. I tend to, because I work with producers, I tend to not use the word bullish or bearish. I tend to say undervalue and overvalue. And by getting back to 335 in December corn, we just hit my undervalue level. We went about 15 cents underneath my undervalue level. And I still believe that the 367 to 385 level in December corn is a possibility, maybe a probability, if the wheat market can turn and generate some support for the corn, which that's the next key, I think.
Yes, and how do you see the macroeconomic data impacting the farmland?
Yeah, this is where we've talked about the locking in corn feed. We've talked about hedging feeder cattle. Those are things that are still top of my priority list. But right up there, Luis, is the idea of getting some equity protection to the downside, some S&P puts bought for hedgers and for their financial needs to protect in case the stock market falls. I think that the market has outrun the data, the economic data. We are seeing more institutions, more colleges, more professional sports teams, more restaurants, and more clothing stores have bad economic news. We're not opening up schools. Many of the big conferences for football are not going to play this year. We've had several big bankruptcies in clothing stores. Restaurants are merging. So I think the demand data, based upon the equity market rally, does not match up. And I think the equity market rally was mainly funded upon the big fiscal stimulus. So I think we're ready for a pullback in the stock market, but that doesn't necessarily mean the agriculture commodities, because they've never participated in this rally. And in fact, the macro data from a consumer price index and producer price index, both of those this week were very strong in the United States. Europe's numbers were somewhat better than expected, and China's numbers were much better than expected when it came to their demand and their imports. So I think the macro data, even without a fiscal stimulus bill, has been a supportive feature, and that's why the U.S. dollar made a new weekly low here at the end of this week. And as long as we keep seeing that, I think the commodity funds will want to not be as short as they have been in the past 6 or 8 months.
And the Chinese trade deal with China, I should say, how is that going to have an effect there, considering the trade and the US dollar?
Yeah, this is where the Chinese currency has been gaining on the US dollar, and many in the market, including myself, are worried about a reversal of that, where the dollar gains on the Chinese currency, and that in turn spooks and creates a more selling pressure in the wheat. And that's why I watch the wheat so closely. So that is something definitely this weekend I will be watching as those trade talks begin. The other side of that is the soybean complex. We've been able to get above $9 futures here at the Board of Trade and new crop beans, and gotten right to the $9 level, or a little bit over the $9 level in the old crop August beans, which are getting ready to go off the board. Those two are probably something that I really don't want to lose any premium here. If we get any bad news, I'll probably try and get some floors underneath me in the soybean complex, since China has bought so much new crop beans that they could pretty easily cancel and disrupt the market rally. So this short-term issue is certainly on my mind. I think it's less of an issue because of the USDA report and the reaction by the trade, but it certainly, I think, could stall the rally if it does not go well this weekend and early next week. If it goes well, though, I think we have some more upside that we can get some better profit opportunities.
In the meantime, I think there is a sort of a wait-and-see tactic from China because you have an election there.
Yes, and I think that this is where the Chinese will probably play how we would say a little more hardball with us than they have in the past, because I do think, based upon the analysis, that they would rather have a new president than a known quantity in President Trump, who is going to continue to force them to seek more domestic consumption to be able to generate their economy and generate their GDP and income. And so I think they probably would rather not have President Trump as the next president. And this is where I'm more concerned about these trade talks, especially in light of some of the more active military posturing in the South China Sea. Our cabinet member, the HHS cabinet member, going over to Taiwan, North Korea and Iran starting to be more a little bit more difficult to deal with. These things all suggest to me that China's probably going to be a little bit more difficult to work with than the last time they were here in Atchison, or excuse me, when they were here in Washington to sign that phase 1 trade deal.
The always clever Mike Zuzolo from Global Commodity Analytics. Thank you.
Thanks, Luis.